You've seen the headlines, the soaring stock charts, the fortunes being made overnight, the AI gold rush is here and it feels like everyone's piling in, convinced they found the next sure thing. But what if this incredible surge is just a mirage? What if I told you the world's most powerful financial institutions are now sending out warnings about a collapse? While the hype is deafening, a growing crowd of experts sees evidence that this gold rush is dangerously speculative. They're saying a major correction isn't just possible, it's becoming probable. And it could have a lot of unprepared investors watching their money vanish. So we're about to break down the signs that the frenzy is disconnected from reality and what you can do to protect yourself. So let's be honest, the numbers are just staggering. The excitement around artificial intelligence has pushed some tech stocks to valuations that are, to put it mildly, stretched thinner than a tight rope. We're not just talking about healthy growth, we're in the kind of market euphoria that has Wall Street veterans nervously eyeing the ghosts of bubbles past. Take a look at the titans of the industry. A company like Nvidia, which makes the essential chips for the AI revolution, has seen its valuation skyrocket, at times trading at over 40 times its forward earnings. Other darlings like ARM Holdings have traded at over 90 times their earnings. To give some perspectives, these are multiples that make even some of the dot-com mania valuations from the late 19th look tame. And this isn't just about one or two high flyers. We're seeing a dangerous concentration of a market value in a handful of AI-related megacap companies. The International Monetary Fund, the IMF, recently warned that market concentration risk is now substantially higher than during the dot-com bubble. What this means is that the fate of the entire market is getting tied to the performance of just a few stocks. If their sky-high valuations stumble, they could drag everyone else with them. This is a classic symptom of a speculative bubble. It's the moment when prices detach from the real world. Fundamentals of a business, things like actual profit and sustainable revenue, are instead driven by belief, by hype, and by a serious case of FOMO. One of the most trusted measurements is the Shiller price to earnings ratio that was developed by Nobel laureate Robert Shiller, who famously called the dot-com crash. This ratio smooths out earnings over 10 years to get a more stable picture. Recently, the S&P 500 Shiller's PE ratio has been hovering near the 40-point mark. That's a level it hasn't seen since the year 2000, right before the dot-com bubble burst and crashed the whole market. Now, analysts are quick to say high valuations doesn't guarantee an immediate crash, but it's a flashing yellow light that the market is expensive relative to its own history. The world's biggest financial institution, from the IMF to the Bank of England, are no longer whispering, they're sounding the alarm. The Bank of England has warned of a growing risk of a sudden correction, which could tighten financial conditions for families and businesses everywhere. Even JP Morgan CEO Jamie Dimon have voiced caution, calling elevated asset prices a major concern. And this is what some are calling the toxic calm before the storm. It's the airy period of the intense excitement where investors are taking huge risks, cash reserves are low, and the market seems to be ignoring the potential for a sudden shock. It's a precarious spot to be in, and history has a bad habit of repeating itself. But this isn't just about the stock charts and financial ratios. This bubble and the technology behind it has a massive impact on the real world, especially the job market. While corporate profits are soaring, we're also seeing waves of mass layoffs, particularly in tech. In 2025 alone, global tech-related jobs cuts have reached staggering numbers, with some reports indicating nearly 90,000 to over 180,000 layoffs by the fall. But what's different this time is why. These aren't just layoffs from companies in crisis. Many of these firms are posting strong growth. Amazon CEO put it bluntly, as they roll out more generative AI, they'll simply need fewer people for certain jobs. This is what some economists are starting to call the white-collar recession. For decades, the thinking was that automation would mostly hit manual blue-collar jobs. But the AI revolution is different. Generative AI can now do tasks that were once the exclusive domain of highly educated professionals. It can write software code, conduct financial research, draft legal documents, and create marketing campaigns. As a result, roles that used to be stable entry points into corporate careers are starting to disappear. Think junior analysts, HR associates, and content strategists. One report tracked thousands of job cuts explicitly blamed on AI in a single month. The CEO of IBM famously estimated that AI could replace thousands of jobs in his company's HR department alone. This creates a strange paradox. The AI revolution is fueling a stock market boom while eroding the very professional job market that supports the economy. Companies can now grow their revenue without growing their human headcount. And this isn't just a temporary dip, it's a structural change in how work gets done. The implications are huge. If unemployment rises among the educated workforce, many of whom have significant student debt, it could set off a domino effect. It could hit consumer spending and the housing market and office real estate, which is already under pressure. The same technology creating incredible wealth is the stock market. In the stock market is also creating unprecedented uncertainty for the workforce. This disconnect is another sign that things just aren't sustainable. bubble. So how is this bubble getting so inflated? Well, beyond the genuine excitement, there are some troubling financial games being played that look eerily similar to the dot-com era's dirty laundry. I'm talking about a practice that's being called circular financing. And here's the simple version of it, how it works. A huge AI company like a chipmaker invests a ton of money into a smaller AI startup. That startup then turns around and uses the exact same money to buy the chipmaker's products. On paper, this makes the chipmaker's revenue and demand look explosive, justifying its crazy stock price. But in reality, it's a closed loop. The money is just sloshing between a few companies, creating the illusion of a booming organic market. Concerns about these kinds of interconnected deals are growing among analysts and financial watchdogs. Reports have highlighted this pattern of circular investments involving major players like OpenAI, Nvidia, AMD, and Oracle. For example, there have been concerns about Nvidia's venture arm investing in dozens of AI companies that then becomes customers for its expensive GPUs. Now, this isn't always illegal. Sometimes it can be a legitimate way to kickstart a new ecosystem, but it can also dangerously blur the line between real demand and financial engineered hype. It feels like a throwback to the dot-com bust, where companies would basically fund their own customers' purchase to pump up their revenue numbers. A house of cards that eventually collapsed. Financial watchdogs have drawn parallels between this kind of activity and the excesses of the early 2000s, when a company's soaring revenue depended on its own investments coming back as sales. The foundation is shaky at best. It raises the big question: how much of the explosive demand are we seeing is real and how much is just clever deal making? Think of it like a game of financial Jenga. Every deal adds another block to the tower, making it look taller and more impressive, but with each block the whole structure gets more and more unstable. If one of these players stumbles, or if the flow of cash slows down, the entire thing could be coming crashing down. And this risk isn't being properly priced into the market, and it's a huge red flag. So let's distill all this down into 3 clear telltale signs that what we're seeing is a speculative bubble, not just a healthy boom. If you can spot this, you can see the market for what it really is, not what the hype says it is. So the first and most classic sign of any bubble is when stock prices get completely unchanged from actual business fundamentals. In a healthy market, a stock price reflects a company's ability to make money. In a bubble, it's a reflection of hope. We're seeing this all over the AI landscape. Many AI startups are hitting billion-dollar valuations with little to no revenue, let alone profit. Even established players have valuations that seem to defy financial gravity. For all its game-changing technology, OpenAI is still losing a staggering amount of money, with financial disclosures showing a net loss of $13.5 billion in the first half of 2025 alone. This is the growth over profits mindset on a whole new level. Investors are pouring cash into companies based on a story about the future, not the current balance sheet. When stock prices are based on narrative instead of numbers, they become incredibly fragile and vulnerable to any shift in sentiment. The second sign is the behavior of investors themselves. Bubbles are fueled by what's often called irrational exuberance, a herd mentality driven by a powerful fear of missing out. We're seeing this in the data. Bank of America's Global Fund Manager survey, which polls the people managing billions of dollars, revealed something startling. For the first time, these professional investors identified an AI equity bubble as the single biggest risk to global markets. A majority of them, 54%, now believe AI stocks are in a bubble. But here's the thing, despite seeing the bubble, many of these same managers are still heavily invested. They are worried about missing out on more gains even as they see the cliff edge getting closer. This is a textbook bubble behavior. At the same time, the survey showed the cash levels among managers are incredibly low, meaning everyone is all in with very little safety cushion. This mix of seeing the risk but being too scared to get out is that toxic calm that so often comes before the fall. It shows a market driven by emotion, not logic. The third, maybe most telling sign is the productivity paradox. The whole sales pitch for the AI boom is that its tech will unlock insane levels of productivity and economic growth. The valuations we see today are pricing in that future right now. But what if that future is further off than we think? While companies are adopting AI tools, many are struggling to see real impact on their bottom line. Researchers talking about a Gen AI paradox. There's a widespread adaptation, but for many there's very little measurable value just yet. One study even found that 95% of organizations investing in generative AI are currently seeing zero return on the investment. And this isn't to say the AI promise is fake. The problem is the timeline. The market is pricing in a complete economic revolution today, but actually integrating AI into businesses, retraining a workforce, and dealing with security and data challenges takes years. The Bank of England has explicitly warned that stock markets are exposed if expectations around AI impacts become less optimistic. If those promised productivity gains don't show up as quickly as the hype promise, those huge valuations will be impossible to justify, and a painful correction could be next. So with all these warning signs, what can you actually do? The goal isn't to panic and hide your money under the mattress. The AI revolution is real and it will create enormous value in the long run. The key is to separate the long-term technological shift from the short-term speculative frenzy. Here are 3 strategies to help you do that. Okay, so first is focus on the businesses, not the buzz. This is a golden rule. In a hype-driven market, it's easy to get swept up in exciting stories, but smart investors look past the narrative and look at the numbers. Don't buy a stock just because it has AI in its name. Look for companies with real tangible value. This means finding companies with strong balance sheets, actual revenue growth, and ideally profits. Ask the tough questions. Does this company have a real business model? Does it have a competitive advantage? A moat that protects it from competitors? Is it priced based on reality or is it floating on pure hope? Profitable, cash-rich companies are far better equipped to ride out a market storm than those that are just burning through money. Second, embrace diversification. Concentration risk in the market right now is no joke. A massive chunk of the S&P 500 gains has come from just a handful of tech giants. Putting all your eggs in one, a very expensive basket is a high-stakes bet. Diversification is your best defense against a crash in one sector. It just means spreading your investments across different industries, asset classes, and even different parts of the world. If the AI bubble does pop, other parts of the economy might hold up much better. We're already seeing hints of this, with some institutional investors naming long gold as one of their top trades, a classic move to a safe haven asset when the uncertainty is high. Think about looking at value stocks, solid dividend paying companies, or even utilities, the kind of boring but stable sectors that get overlooked when everyone is chasing growth. Remember, I'm not a financial advisor, this is for educational and entertainment purpose only. Third is invest in yourself and play the long game. It's so important to distinguish between the stock market bubble and the technology itself. The internet bubble burst spectacularly in 2000, but the internet still went on to change the world. The same will almost certainly be true for AI. Long-term impact of this technology will be massive. So one of the best investments you can make is in your own skills. As we talked about, AI is changing the job market. Learning how to use AI tools, developing skills in related fields like data analysis, and becoming an AI-ready professional is the ultimate way to secure your own financial future. The jobs of tomorrow won't be competing against AI, but working with it. From an investing standpoint, this means thinking in decades, not days. Instead of trying to time the market perfectly, focus on identifying the companies that are built to be long-term winners, the ones with strong fundamentals and clear sustainable strategies. The bubble may pop, but the revolution is just getting started. So what is really going on with the AI bubble? Well, the evidence seems pretty clear. We're in a period of intensive speculative hype. Valuations are disconnected from profits. Investors' behavior is being driven by emotion, and the world's most credible financial institutions are raising their voices in warning. We're seeing all the classic symptoms from financial engineering that props up revenue to a productive paradox, where the real-world impact is lagging far behind the market's excitement. At the same time, this tech wave is causing a big shift in the job market, creating a white-collar squeeze that adds another layer of instability. A correction feels not just possible but probable, but this doesn't mean the age of AI is a lie. It just means that the market's first reactions has been way overheated. The true value of AI will be realized over decades, not fiscal quarters. By focusing on fundamentals, diversifying your assets, and investing in your own adaptability, you can survive the great pop and be in a great position to thrive in the AI-powered world that comes next. This is a critical moment for every investor, and the choice you make now could shape your financial health for years. But now I want to hear from you. Do you think we're in a bubble, or is this time truly different? What signs are you watching? Let me know down below in the comments. If this analysis helped you make sense of what's going on, hit that like button and make sure you subscribe for more deep dive into the forces that are shaping our financial future, and check out my other videos, and I'll see you guys in the next video. Bye.